So guys, this video is going to be a little bit different than our usual video. I'm going to cover 3 hot stock market topics in this one show. A lot of you coming in this video might be trying to find the next hot stock like Nvidia or Palantir. Well, I'm going to help you analyze a stock and show you exactly how to filter out the losers being hyped like winners. So I've got this article pulled up behind me. Yahoo Finance is talking about 3 so-called breakout stocks that they say are worth buying right now. Now, whenever I see a headline like this, I get it. It grabs attention. It's the right thing to do from a marketing perspective. People want to find the next big thing. But we have to remember something extremely important. Just because a stock's been hot or sounds exciting, that doesn't mean it's a good investment today. We need to understand and look at the business, the numbers, the fundamentals, and then the valuation. We need to dig just a little bit deeper to see if it's just a quick, hey, hype thing, or there's something to the story. So let's walk through what they're saying. First up is AppLovin. This one's being hyped up as an AI-powered advertising machine. They've delivered big returns in the last 3 years. The article says they're using Axon 2.0 technology to help advertisers find the right users and lower customer acquisition costs, blah, 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 blah. That sounds great. They even have 56% operating margins, which is beyond impressive for a tech business. So clearly a lot of great stuff there. But the last 12 months, their PE is 87. Guys, that's not cheap. But remember, that alone doesn't mean it's necessarily overpriced. You are paying a high price, but if there's way more future growth than we realize, then it could be cheap. But in most situations, all that future growth is probably baked into the stock price today. And unless they operate perfectly, any slip up can really hurt the stock price. So, is it a great business? Maybe. But we still have to figure out what price makes sense based on the future potential of the business. Next up is CrowdStrike. Now, this is a company that had a rough patch earlier this year, but according to the article, customers stuck around and the stock has rebounded big time. They're in cybersecurity, which is a massive growing industry and will probably only get bigger. But remember, 100 some years ago, airlines and autos was a massively growing industry, still is today. But if you'd invested in every single airline or auto company that ever started, you would be a money loser today, even with all the great companies that still exist. The way the article puts it, this isn't your old antivirus software. It's AI native, which basically means it learns and adapts in real time to threats. That's powerful, guys. They've got growing customer retention, strong cash flow, and they're expanding into more services. I love all of that. But again, the question comes down to valuation. How much are we paying for that growth, for that story? The market loves a story. But as investors, as value investors, we care about the story and the numbers together. Can the numbers justify that story? And finally, Dutch Bros. This is a coffee company that's building a name for itself with drive-through stores and what they call broistas. They're trying to build into the next Starbucks but with a twist. Cold drinks, energy drinks, and more fun vibe. They want over 2,000 locations by 2029, so they're growing fast. As of October 15th of 2025, they have a shade over 1,000 stores. So that's doubling in the next 3 or 4 years. That's aggressive. The article says they're doing over 5% same-store sales growth. Guys, that's big. What that means is stores that have been around for 12 months or longer, or whatever metric they give, have sales growth of 5% per year. That's really important to look at on retail. It's important to see, are their existing stores still growing? And they're also expanding into packaged drinks next year. But the stock is down 40% from its highs. So if you thought AppLovin was expensive at 87 times PE, this is 124. That's extremely expensive for any business. Now, I get it. If they can double their profit, it makes that 124 not as expensive. I get the growth story, and I love companies with strong brand loyalty, but the math has to work. If you're paying that kind of premium, you better be really confident they can deliver years and years of great, consistent growth. Otherwise, you're just going to set yourself up for disappointment. Because in the short run, stocks are a voting machine. In the long run, they're a weighing machine. So overall, the articles focus on fast-growing companies with strong business stories. But just because a company is growing or using AI doesn't automatically make it a great investment. We have to ask, is the stock cheap enough to give us a great return going forward. That's what we're here to do. We're here to run the numbers. We're here to stay disciplined. And we're here to find out if there's a real opportunity here, or is this just another hype headline? So let's go analyze the most exciting of the 3 stocks right now. And in my opinion, that is CrowdStrike. But we're not just chasing the hype. We're going to look at it through the lens of a true investor. So guys, in the last month, it's down 9%. Year to date, it's up 47%. Guess what that means for investors? Nothing. If you chase ticker symbols and prices up and down, that matters to you. For us, it does not matter. What matters to us is what's behind the numbers. Okay, so this is a $128 billion market cap business. If you bought all the shares in the market, you'd own 100% of them, if this was possible, for $128 billion. Now, enterprise value is $129 billion. That difference of $1 billion is essentially their debt. Guys, they generated $1 billion last year in free cash flow. So they can pay that off very quickly. Great balance sheet. Another thing I want to show you. Look at this, interesting. Net income last year was negative $300 million. 5-year average, negative $117 million. Not very good, right? Yeah, but look at this free cash flow. Last year was $1.1 billion. Last 5-year average was $800 million. So I want you to understand why that is. The right investor needs to understand this is a big difference. This is like Palantir type of shit, where Palantir was losing money on their net income, but their free cash flow was in the positive, and they were having quarter after quarter of positive cash flow. Important to understand that. Now, their current price to free cash flow is 115. Guys, look at this. Gross profit, 74%. That's a big number. That's higher than Microsoft. Every extra dollar they sell, 74 cents of it goes to the bottom line before overhead and taxes. That is a great way to increase your profit and cash flow very, very quickly. So I'm already seeing a lot of positive information here. 3-year revenue growth, 31% a year, 5-year, 43%. In the last 5 years, they've done acquisitions of $1 billion. That is not a lot for a company that's valued $128 billion, but it's kind of a lot for a company that generates $1 billion a year in free cash flow. So one big metric I look at whenever I look at any company to compare with the industry, price to sales ratio. Guys, the price to sales ratio here is 28. What does this ratio mean? Well, what it means is if you take the entire market cap of the business and divide it by revenue, it's 28. And that works out. 128 billion divided by 3.74 billion in revenue. For every dollar of revenue, you have to pay $28 to own this company. A company like Microsoft is currently 12 to 14. That's not so bueno. Now, this is double what Microsoft is, but the growth potential is way better than Microsoft. So that's okay. You have to figure that in there. And I also think Microsoft's a little overpriced right now. So maybe typical for a software business should be 8 to 10. I don't know exactly. But the point is, this is expensive. But we have to understand the growth story. Now, guys, if this feels overwhelming, trust me when I say this. You're not alone. I've been there. Everybody watching this video, we have thousands of people in our community. They were there. We're here to simplify all of this. These key metrics matter. These absolutely matter. Now, you're probably looking at this saying, oh my God, this is a lot. Yes, but guess what? I made a cheat sheet for you. I made a cheat sheet that'll explain every single metric on this page, what it means, and why it matters. If you're interested in getting that, click the link below. It'll be given to you in a matter of minutes. Click it, put it in there, keep this PDF handy whenever you watch any video of ours, but also learn it for yourself. Whenever you're researching on your own, especially if you have our software, it's a great go-to. And I always tell people, I have friends who love listening to my videos just so they can use those metrics in meetings and sound really smart. And they'll brag to me saying, oh, look, I said this 5-year blah, blah, blah. People are like, damn, you know what you're talking about. It's a great way to be cocky. Guys, the reason I talk about this and want you to have this key metrics PDF that's free is because this is exactly why I teach on YouTube. I see all these YouTube hypesters out there just talking about, look at the stock, it's up a ton, this is great. Guys, it's about the fundamentals. And in a few minutes, we're gonna go over the right price I believe to pay for CrowdStrike. But this is so important that I want people to realize when you buy a stock, you're buying a piece of a business. You're not buying a ticker that goes up and down. So let's look at the 8 pillars here. Now, the 8 pillars are not to be taken as a buy or sell idea. It's about saying, what's the story here? I see a lot of X's here. Guys, we knew the valuation is going to be bad. Cash flow's up. Revenue's up. Net income is down. We have to figure the most important thing after we do stock analyzer, if this company is within a realm of possibility, you got to understand why is there such a big difference between cash flow and net income. It's really important to understand that. Shares outstanding, they're diluting a little bit, but not a ton. 10% over 5 years ain't the worst, but it's still something to consider about. Guys, these numbers to me don't mean much because this company's still growing. It's still in early phases. Yes, it's valued at $128 billion, which is a lot, but we have to sit there and say like, hey, we have to give this company that does $3.8 billion a little bit of leeway to grow into that. So these numbers aren't exactly the worst thing in the world for me to worry about. So let's go to our stock analyzer tool. This is where we merge the numbers and the story together. Have I ever down CrowdStrike? I have, almost 2 years ago now. But before we put our assumptions in, let's go to our analyst estimates. Guys, look at this. So they're way off here. Analysts were expecting $3.83 in profit for March of 2025, growing to $10.24. So they're already missing this thing. Revenue-wise, $4 billion, didn't hit that, growing to $10 billion in the next 4 or 5 years. Remember this. Analysts are wrong on this one. Don't take what they say just as but the bottom line is this company has a lot of growth potential. So we're going to go back to stock analyzer tool. Now, guys, here's what I'm going to do. I'm going to do 10, 17.5, and 25% revenue growth for the next 10 years. That's a lot. That's a whole lot. You saw analysts were putting 20% for the next 5 years. I'm putting 10, 17.5, and 25 for the next 10 years. So I'm being aggressive here. Now, profit margin. I'm just going to replicate profit and free cash flow. I'm doing 25, 30, and 35% margin. Why? Because it did 28% in the last 5 years. It's down a little bit last year, so I'm okay with this number. Now, what is the PE or price to free cash flow that you would put on this company 10 years from now? Well, guys, I always tell people start at 15 to 16, which is the market average, go up for good companies, down for bad companies. What makes a good company? High returns on capital. They don't have this yet, but they're getting better. Great growth potential and leaders in the industry. I don't know where this company stands on it. I'm going to give them the benefit of the doubt and say it's a great business. I'm putting 18, 21, and 24. And then finally, what's my desired return? Well, guys, when I want to figure out what the company's worth, not what it's worth to me, what it's worth to the market, I always put in 9%. Just saying, hey, listen, match the market return, 9, 10%, put it in there. But if I'm buying this for myself, I want margin of safety because the future is unknown and we are humans and we make mistakes. So I need a higher return than this. But for purposes of this video, I'm starting here. Now, I hit the analyze button, scroll down. This is why I'm a little apprehensive. Low price of 130, high price of 720, middle price of 300. And I think I put some aggressive assumptions in there. So I'm not looking at this company anytime soon. It's too far away from my price. I'm probably interested sub 250 at best. So I'm looking at going, move on, find a different company. That's my opinion. Now, the great thing about investing is you might know better about this company than I do. People in our community always talk about companies that are different. So if you're in our community, do me a favor, have the conversation about this if you think I'm missing something. So guys, whenever we make these videos, just like these articles, we do put in titles in there that'll get attention, but the goal for us is to teach a lesson in those titles. Even if it's a title that says, hey, the crash is coming, we're here to teach that crashes don't matter. They're your opportunity. Whatever the title is, I want you to realize there will be a more important story buried in that when we make the video. Now, our second topic in this video is one of the most important lessons that you need to know and understand. It is the difference between investing and speculating. And I'm telling you right now, if you can understand this one thing, you're already ahead of 98 or 99% of people that put their money into the stock market. On this channel at Everything Money, one of our core principles is this. We are investors, not speculators. That's not just a catchy line. We live by it. Because the truth is, most people think they're investing just because they put money into something, when really they're just guessing, which is gambling, which is speculation. They're chasing hot stocks. They're chasing prices going up and down. They're reacting to headlines and they're following hype. That's not investing, guys. That is pure speculation. Warren Buffett has said, and I love this, if you wouldn't hold a stock for 10 years, don't even think about owning it for 10 seconds. And Charlie Munger, his more blunt associate, who has now passed, was even more blunt. It's not supposed to be easy. If it feels easy, you're probably doing it wrong. Real investing takes work. It takes patience. It takes discipline. Now, this is different than dollar cost averaging. Ironically, dollar cost averaging is extremely easy and it works very well, but that's a different topic altogether. So I'm here to make this very simple. Think of it like buying your neighbor's lemonade stand. If you're investing and they come to you and say, hey, I have this lemonade stand, would you buy in it? You're not going to say, well, what's the price today? What was it 6 months ago? No, you're going to say, How much revenue does it bring in? How much money does it make? What are your expenses? Who's running it? What's your growth potential? What am I paying today to compare to what I'll earn in the future? That's investing. And it boggles my mind. A great story. And I'm probably calling this guy out, but he probably doesn't watch my videos anyhow. I own a property in Mexico, and my neighbor, who's a successful business person, is a big Tesla hipster. And he owns Tesla, and he thinks it's the best thing ever. He thinks nothing can stop it. Well, I was buying another house, and I said to him, hey, since you're in the area, would you like to partner? He said, that's great. I said, okay, here's what I'm buying it for. He's like, well, wait a second. What are you going to rent it for? What are you going to do? He asked me all these questions, and I chuckled and thought, man, he doesn't ask the same questions about Tesla stock. He just blindly falls Tesla stock. But in an area where he owns the house next door and could answer all those questions himself, knowing full well that we did better than he did on our rentals, he asked me 1,000 questions. And I was like, isn't that ironic? I always joke and tell people spend more time researching the car they're buying to save $500 or $1,000 than they do to buy a stock, and it blows my mind. But if you're just thinking, back to the lemonade stand, that the lemonade stand is trending and the person says, well, a year ago I thought it was worth $10,000, now it's worth $20,000, then that's speculation. You're not buying a business then. You're just buying on emotion and pricing, and that's where people get burned. Don't get me wrong. I believe in day trading. I believe in long-term trading. That's separate. But when you're buying a company, when you're trying to buy a company for the long run, you have to look at the fundamentals. Every dollar you put in the stock market or into a business, you need to know what you're buying. How is it going to make money? What kind of return can you expect based on the real numbers? If you can't answer these simple questions, you're not investing. You're gambling. We're not here to gamble. Another thing I always tell people is, it's kind of off a Warren Buffett analogy. If you bought a company today and the market went away tomorrow, would you be okay with that? If the answer to that is no, you're not investing. You're speculating. Every company I own 28 companies in the stock market. I wish the stock market would go away for 10 years because I just want to wake up 10 years from now and not see any price fluctuations and just wake up and all these companies make more money and the stock is probably much higher. That's how wealth is built. We're here to invest with logic. We're here to invest with process. And the hardest one, we're here to invest with patience. If you buy something where the only way you make money is because the price goes up, you're speculating. You're not investing. Think Bitcoin. Think gold. Think baseball cards. Think art. These are speculation plays. This is one of the hardest things to get people to understand, speculation versus investing. Like I look at the Bitcoin world. Everybody says, oh, I understand Bitcoin. I understand Bitcoin. You might understand blockchain. You might understand what Bitcoin does. But if you're not understanding the whole idea of what's its value, then you can talk to your blue in the face about that. You're not understanding the investment portion of it, and it's still speculation. And by the way, guys, people can speculate and still make a lot of money. But the question is, when you're buying an individual company, a stock, what are you buying? You're buying a piece of a business, and that requires investment thoughts, not speculation. Hope is not a plan. I used to buy stocks hoping that they would go up, but hope doesn't protect you when the market turns. Hope doesn't help you sleep better at night. Hope doesn't decrease your fear. I had to learn how to build a real strategy, one that makes sure that I personally never go to zero. Now, every investment I make is based on numbers, not hype. This is why I built Everything Money. It was built for me. I wanted the tools that gave me clarity, took the fear out of investing, and helped me make better decisions that helped me sleep better. People saw me using them on YouTube and said, Paul, can you give us that software? And I said, well, I can't because it's mine right now, but I can create it. And so I did, and a real community was born. Real people sharing ideas, live chats, live streams, and tools that help beat 99% of investors. I still use these tools like the stock analyzer every single day. Stop guessing, start learning. Click the link below, try our trial, $7 for 7 days, and see how confidence will replace your fear. So this now leads us to our third topic. Guys, there's a lot of talk recently about the Fed, about the economy. And Donald Trump is sitting here, he's changing the Fed chair. Come next year, he wants aggressive rate cuts. So first off, I don't agree with aggressive rate cuts in general. I think rates higher are better for investors. That might sound counterintuitive, but in the long run, if rates are lower, money's cheap, stupid money's chasing bad deals, things are not good. I'm in the real estate world. I'm the only real estate guy I know who loves higher rates because I hate the garbage that comes with lower rates. Same with stocks. It's a justifiable, oh, when rates were 0%, well, I can invest in the S&P and get a 2% dividend, 1.5% dividend without understanding the downside risk. But But I go back to what Warren Buffett always said. If the Fed chair was there every single day to tell him what he's going to do a year from now, it would not change how he invests. Now, I might say extreme about that. Maybe, maybe not. If I thought that a recession was imminent, I would definitely be more apprehensive about buying new investments that are reliant on the economy. But if I were able to get a great price for a business and it went lower because of the economy or because of the Fed, I would love it. My point too is this. Stop worrying about the economy and the Fed. We're here to teach this process of buying great businesses at great prices. We're here not to worry about the noise, because guess what, guys? There's a lot of noise out there, and it's easy to get distracted, whether it's Fed rates, bad things, good things, economy. There are millions of data points in the economy. I remember when people were so worried about rates going up and home prices collapsing, and you can watch our videos in the past when this happened, and we said, we're not thoroughly convinced home prices would fall. And the reason being is supply and demand. With inflation up, the cost to build is going to jump up. When the cost to build jumps up, it makes existing inventory more expensive. In addition to that, if your rate was 3%, it jumped to 7%, you weren't selling your 3% house unless you absolutely had to. That means less supply. When there's less supply, prices jump up. Recently, prices have come down a little bit on higher end in a lot of markets. We're in Cleveland, Ohio, considered one of the worst economic areas in the country, and I always laugh at that because our prices are skyrocketing on real estate. It is so hard to find a house that's decent, that you can buy at a decent price. Homes just go off the shelf just like that. You can sit there and guess till you're blue in the face. You have no idea what's going to happen. That's why the idea of dollar cost averaging and a low cost ETFs, no matter what's happening, and buying great companies at great prices is so important. And if those company prices fall and you still see the same thesis, you buy more of it. That's the key. So guys, if you enjoyed this video and you're seeing the difference between real investing and chasing hype, you're definitely going to want to watch the next video. In it, I go through 3 stocks to buy, as well as 3 stocks to sell. And trust me, some of the names in that list are going to surprise you. It's not just a list of tickers. It's a breakdown of why certain companies make sense right now and why others might look good on the surface, but could be setting you up for disappointment. You're going to get a clear look at how I actually think through buying and selling decisions. And it's a great lesson in applying everything we just talked about. So if you want to see this process in action and maybe even challenge some of your own assumptions or mine, click the video on your screen. It's one of those videos that you really can shift how you look at your portfolio. Thank you for your time.